So the S&P 500 is now down about 6% in the last couple of weeks, and the NASDAQ index is down about 10%. Now, of course, we could all take a random guess as to when we think this latest market correction will be over, but that wouldn't be any more accurate than flipping a coin. In this video, I want to show you all a very simple volatility metric that you can all check at any time that can give you an idea for market sentiment and perhaps let you know when the stock market is about to recover. Now, I do send out a dashboard of many more robust volatility metrics in every daily email to the VTS community. If you're not a member yet, definitely claim your free trial to VTS on my website. Every single day, I want you checking the VIX futures at VIXCentral.com. This is what's called the VIX futures term structure. Now, every one of these points is a VIX future, and they represent the market's estimation of forward volatility for each month going out in time. So March, April, May, all the way out to October. In a stable market, when everything is calm and the S&P 500 is just trending higher, those VIX futures will align themselves in what we call Contango. That's when the longer dated VIX futures are priced higher than the shorter dated VIX futures. A good example of this would be from just a couple of months ago. This is January 8th, 2025. Notice how each VIX future further out in time is higher than the previous one. Again, this is called Contango. And this makes sense for stable markets, right? The VIX futures are a freely traded market, so in stable markets, of course, all the traders out there are going to need to be compensated for taking on that future unknown risk. There's an expected premium priced into the market because more bad things can happen 3 to 4 months from now than compared to, say, 1 month. This is why in a stable market, they get priced higher as you go out in time. Now, back to our VIX futures term structure right now today, during this latest market correction, we can see it's the opposite shape. This is called backwardation. Backwardation is when shorter dated VIX futures are priced higher than the longer dated ones. This should also make sense when you think about it from the perspective of a trader. If things are ugly today, of course those shorter dated contracts are going to be priced high. High market volatility means higher priced VIX futures. But it's pretty likely that whatever is causing the market to drop recently, within 3 or 4 months, that should probably be resolved. It's rational to assume that in a few months the VIX will come back down. That's why right now the VIX futures further out in time are lower than the shorter dated ones. Now we can actually calculate the percentage of current contango or backwardation. That's just the difference between the first and second month VIX future. We can see that as a percentage, right now it's minus 4.39%. 4.39% in backwardation, a negative number. Now, if we plot those daily percentages on a long-term chart going back to the launch of VIX futures in March 2004, so over 20 years now, this is what it looks like. Remember, contango would be positive numbers above 0% representing stable markets. Now, what if I were to tell you that the VIX futures are in contango on about 84% of trading days? This means VIX futures are only in backwardation and showing elevated risk on about 16% of trading days. That's a pretty easy way to filter out the riskiest days. Right now, today, because we are in the middle of one of those market corrections, we're also in those lower red levels, marking backwardation. But like I said, as a general gauge of market sentiment, you can check those VIX futures every day looking for that moment where they flip from negative to positive, from backwardation into contango. That would be a good initial signal showing that perhaps the markets are ready to calm down again. Now, of course, there are no guarantees in trading, and just because the VIX futures will flip to contango doesn't mean there's no risk anymore. It could just flip and go right back down. But as traders, we don't want to be making random guesses as to where we think the market is going. We want to put the odds in our favor and use some mathematical signals. Now, the VIX futures are just one small aspect of my overall volatility barometer. I go a whole lot deeper than just one metric. But like I said, if you don't have access to it, I still want you checking those VIX futures every day and incorporating it into your trading system. Having hard metrics and real numbers to look at will make you far more money long term than just flipping coins. All volatility ETP trading at some point comes through those VIX futures expiration cycles, so check out this video because you definitely need to understand that. If you want to be an expert volatility trader, the secret lies in those VIX futures. See you next time.